In today's lesson, we are going to be looking at another very important topic in accounting. It is called balance sheet. It is called what? Balance sheet. So people call it balance sheet. Whatever it is, but the fundamental thing about the topic is that it is a statement of financial position. That's all about the topic. Now, before we make progress, let's quickly look at what I call the lesson objectives, what we intend to achieve within the period we are going to look at this topic. Now, the first thing we are expecting to achieve as an objective, number one, is that we want to define balance sheet, what balance sheet is all about. And then we want to look at items of a balance sheet, those transactions that one can easily find in the balance sheet. And the last one is to solve related problems. Now, at the end of the lesson, students should be able to define balance sheet, explain the items of a balance sheet, and solve related problems. If at the end of our lesson, we are able to define balance sheet, explain items of the balance sheet, and solve related problem, that means we have achieved our objective. Now let's look at the definition of a balance sheet. We said a balance sheet can be defined as a statement that shows the presentation of the summary of assets and liabilities in a well-arranged form, so that the financial position of an organization may be clearly ascertained. What do I mean? I said it shows the presentation of the summary of assets and liabilities in a well-arranged form, so that the financial position of an organization may be clearly ascertained. That is to say that with the preparation of a balance sheet, one can easily ascertain the financial position of a company or an organization. Another thing we need to understand about it is that apart from the fact that it shows a well-arranged statement, it also depicts, or it also gives a picture of the asset and the liabilities of an organization within a period of time. It's a statement which shows the asset and liabilities of an organization within a period of time. That is to say that if you find it very difficult to retain, or if you find it very difficult to give the definition, maybe it is bulky or very lengthy, you can put in a very simple form that it shows a statement that shows the assets and the liabilities of an organization within a period of time. When we talk about the financial position of an organization, we are just talking about their assets and their liabilities. Now, having said this, every account or a statement must come with what we call the heading. The heading of an account is what some other person will call title. Is very, very important. The heading of an account has three key fundamental information to pass across to users of the statement or the account. Number one, it will show you the name of the statement. Which statement are you preparing? Are you preparing trial balance? Are you preparing balance sheet? Are you preparing cash flow statement? These are various statements that we have. So the statement, the name of the statement must be clearly stated. And then the owner of the statement, in whose name are you preparing the statement? Which particular company owns the statement? You must indicate the name of the company, and the last but not the least is the period under which the statement is being prepared. So for a balance sheet, the heading should be balance sheet of a particular company, ABC Nigeria Limited, as at 31st, the period at which you are preparing, or the period under which you are preparing the statement. Basically, accounting preparations run from January to December, but it varies with company depending on the policy of the company. Now, let's look at the items of a balance sheet. The items of a typical balance sheet is divided into the following. Now, in the definition, I made emphasis on asset. and liabilities. The financial position of every company is centered on what? Assets and what? Liabilities. So the totality of all the transactions under a balance sheet can be captured under just two categories of items, which is the asset and the what? Liabilities. Let's take a look at what an asset is. Now, assets are properties owned and controlled by an organization which has the ability to generate future economic benefit to the organization. What do I mean? An asset has to do with items or properties owned and controlled. I usually tell students not to forget the word owned and control. You can own what you don't control, and you can control what you don't own. If you are living in a self-contained, that house, you are the one controlling the house because you have paid rent. Within the period under which you have paid that rent, that house is your own. You are the one. That house is under your control. The owner or the landlord cannot come and tell you, don't sleep here, sleep here. But you don't own the house. At the expiration of that period, the house belongs to the owner. So, but if this item or property must be qualified as an asset, then it must be owned and it must be controlled. Some other time you can own what you cannot control. You can have something under possession that you may not have total control over. And then it is divided into two. Number one, fixed assets. Fixed assets, these are assets that can last for more than one accounting year. They are land and building, plant and machinery, furniture and fitting, motor vehicle, etc. And then the second one is current assets. Current assets are assets that cannot last for more than one accounting year. Number one, they are stock of goods, cash in hand and bank, debtors, bills receivable, etc., etc. They are more than that. It varies with companies. You know, what a company will classify as asset is different from what another company will classify as asset. But what we serve as a basis of classification is the nature and the size of a company. A company that is trading, maybe a service providing company or probably a manufacturing company that is worth 10 billion may not want to classify an item of 20,000 as an asset. They may want to expense it. But a company that worth 1 million may want to classify an item of 50,000 as an asset. So the name of the classification of an asset varies with what companies. And then I also want to bring to our knowledge that fixed asset can also be called non-current assets. And then when you talk about non-current assets, they are assets that can last for more than 1 year. Now let's look at liabilities. Liabilities are amount owed by the business to the outsiders. They are obligations to pay someone in either money or money's worth. They are divided into one, long-term or non-current liabilities. And then the second one is a short-term or current liability. Now let's look at liabilities a bit before we look at the types. Liabilities, what's the claim of outsiders over the business. If you are doing a business, we have only two sources of assets. One, the one that is provided by the owner of the company, and the one that is sourced from outsiders. So when you collect money from outsiders to start up a business or to expand a business or to better off a business, that money needs to be returned. So as long as that money remains in the company, as long as that money has not been returned back to the owner, it is a liability. And then we have the money that can last for more than 1 year, and then we have the one that cannot last for more than 1 year. When the obligation or when the debt is something you are under an obligation to pay within 1 year, it is called short-term or current liabilities. They include, number one, creditors, bank overdraft, short-term loans, bills payable. But if that loan if that money or that loan is something you are expected to pay within a very long time, you have like more than 1 year to pay, it is called long-term or non-current liability. And the very first one you always see is capital. Nobody can invest money into a business and expect that money to be recovered instantaneously. It must take maybe 1 year or 2 years or thereabout before you can recover it. That is why capital is always a long-term or non-current liabilities. Now, having said that, let's make progress. Now, before we take an illustration of what a balance sheet is, I want to explain something. A balance sheet can actually be prepared in two different ways. It can come in the form of a T like this, where you have your asset this way and you have your liability this way. Or it can come in the form of a vertical presentation. This vertical presentation does not come with a line like this, does not come with this kind of ruling. What you just need to do is just to represent your assets, your fixed asset. You have your fixed asset, you have cost, you have depreciation, and then you have your net book value, where you list all the asset, plant and machinery. Let's assume it's 50,000. Maybe there will be, let's assume the depreciation is 1,000, and then your net book value is here minus here. You have what? You have 49,000. And then you have, let's assume motor vehicle. This is 30,000. Let's assume their depreciation is 2,000. And then if you subtract this from this, you have 28,000. When you add all of this together, 28 plus 49. If you add 49,000 plus 28,000, you'll be giving 77,000. This 77,000, you are now going to, this is what you have arrived at as the worth of your non-current asset. Then you are now going to get your current asset. Let's assume your current asset. You have stock. You have stock here. Maybe you have 10,000. You have debtors. You have 5,000. You have cash, 2,000. This is 17,000. This is 17. This 17,000. You are now going to remove your current liabilities. Current liabilities. Let's assume your current liabilities. We have creditors, 10,000. We have bank overdraft. We have 2,000. This is 12,000. So this 12,000 will be subtracted from here. You have what? 5,000. This 5,000 is what will be added to 77,000 to give you 82,000. This 82,000 that we will get at the end of adding this to this, that is the worth of your assets. And then to be able to get the capital that is used for the period, you are not going to have they will say financed by. Their financed by will come with the capital that is invested, and then if there are any other long-term loan or maybe drawings, anything that affect capital will now follow suit. Once you do that, you have prepared a typical balance sheet. Now, having said that, let us quickly go to our exam guide to see some related questions that will help us to further explain the subject matter. So if you go to our exam guide, you will see options for subjects. You click on account because that's where we are. We are looking at financial accounting. Now, when you click on account, you come down to the year. If you click on year, it will give you years, different years. You know, your area of interest might be in a particular year. You can choose 2021, 2019, depending on your area of interest. But for the sake of this lesson, we are going to click on random. The reason is because we want to bring all of them together to see if we'll be able to get questions that that relate to what we are doing. And then after that, you now click on get started. When you click on get started, the options, the questions will be coming. Now let's look at a question that relates to what we are doing. Okay, now we will look at a question that, all right, let's look at this one. They say the correct order of liquidity is dash. When we talk about liquidity, we are talking about assets that has the possibility or the tendency to be converted into cash. You know, when we talk about current asset, remember we have said current assets are assets that may not last for more than 1 year. So we are looking at an asset that can easily slip out of our hand, that can easily be converted into cash or into something that you can spend. So when you look at it, stock, cash, debtors, and prepayment. Stock is when it comes to stock is hard because you have to sell before it can be converted into cash. Cash is already there. Then debtors, you are not really very sure. You are not really very sure of when this person will bring the money. And then prepayment, these are money that you have paid ahead of the benefit. So it cannot be that. Let's look at cash, prepayment, debtors, and stock. I think the answer here is B. Cash, prepayment, debtors, and stock. If you look at this order, you see that cash is already cash. You can spend it at any time. Then prepayment, money that is spent ahead of a benefit. You are living in a self-contained, and then somehow you decide to pay 2 years ahead of your house rent. That extra money that you have paid is what we call prepayment. So that money is gone. So is gone. Is the money that it becomes an asset to you because you have not benefited from the house. So it's an asset. So after cash, you have prepayment, and then you have debtors before stock. Debtors, your debtor can just decide to come and pay you right away. So, but what you have in your stock, you don't know when customers can come and buy. So the order of liquidity goes thus: cash, prepayment, debtors, and what? Stock. Let's look at another one. Okay. They said, which of the following is added to the proprietor's capital? Whenever you've committed fund into a business, that money that you committed into the business is called capital. And what among these options will be added is a very straightforward question. What should be added is what? Net profit. Net profit is the profit you realize after you have deducted your total expenses. So the answer is A. Now they said balance sheet shows only dash. I have explained from the beginning that balance sheet shows what? Asset and liability. A, asset and capital, asset and long-term liabilities, asset and liabilities, and fixed asset and current asset. The answer is C, asset and liabilities. The balance sheet is prepared to reveal what? The financial position of a business, the result of operations for the period under review, the arithmetical accuracy of the ledger, the accruals and prepayment, the financial position of a business. Let's take the very last question. Another name for owner's equity is what? Capital. When we talk about owner's equity, we are talking about the owner's benefit. What do you stand, or what is your own stake in a business? What did you bring to the table as the owner of a business? Whatever you introduce into the business becomes your equity, and it is capital. This capital may not be just money. Some proprietors or proprietors can decide to introduce their van, their car, part of their building as their contribution to the business. Whatever the owner of the business introduces, whether cash or item or product, becomes their capital. So far, we have looked at a balance sheet as a topic, and we said that a balance sheet is a statement that shows the asset and the liabilities of a company within a particular period of time. And we said that when we said it covers asset and liability, we are saying that the asset of that company is simply the product, or what we call the properties owned and controlled by the company, which has the ability to generate economic value. When we say economic value, future economic value, every asset must has what it takes to generate future economic value. Until that asset is owned and controlled and has what it takes to generate economic value, it is not called an asset. And then we said it's divided into two: fixed asset and what? Current asset. We said fixed asset can also be called non-current asset. And then fixed asset can last for more than 1 year. We said plant and machineries. We said land and building. We said furniture and fitting. And we said motor vehicle, etc., etc. We have said that we should not limit our understanding to just these items, because the asset varies with companies. What could be an asset in a company might just be an expense in another company. Like in a school where they are teaching, the school can decide to use the white marker board as an asset because it will last for a very long time. But in an ordinary company where the board might just be used maybe for interview, there is no serious thing that is done around the board, it might just be expense. The money that is spent to buy a board may just be expense, so it varies with what company. And then current asset are assets that cannot last for more than 1 year. We have said the stock, debtors, cash at bank, and cash at hand. And then we said liabilities are claim of outsiders over the business, the obligation, what you are expected to pay the outside world. The money you collected or you borrowed from the people to start up the business, you need to pay them. We said when this money can last for more than 1 year, they are called long-term liabilities. And when this money cannot last for more than 1 year, they are called what? Short-term liabilities. And we have given examples of long-term liability, and we say one of them is capital. The second one is long-term loan. And then for short-term liabilities, we said they are what? Creditors, they are bank overdraft, they are short-term loan, etc., etc. Now, we have described that when you talk about balance sheet, you are looking at a statement. It is not an account per se. You can either get it in a T format like this, where you have your fixed asset like this, and then you have cost, you have depreciation, and then you have your net book value, where you list all your assets here, you write the amount, then you deduct your depreciation, and then you get your net book value. While by the time you get that, you come down after you have exhausted the number of assets. The next item is what? The current asset. Now, at the end of the day, this side must be equal to this side. That's if you are using the T method. But if you are using the vertical method, you just write your fixed asset, and then you write cost, you write depreciation, and you write your net book value. You list your items. Once we've gotten the answer, compare your current asset with your current liability. The difference should be added, and then you get your equity, your long-term liabilities. We call it finance. The finances used to foot the business. All right, so far that is how we can go for today's lesson.